morning, good afternoon, everyone, and welcome to the virtual panel on the Africa Private Credit Funds. My name is Stephen Priestley. I'm the head of the Financial Services Group at BII. And it's my pleasure to moderate this panel today. So we're fortunate to have to join me three industry experts at this that will join me in a conversation. And then we'll follow it by a Q&A session. So please be thinking about your questions and put it into the Q&A box. So let me start by introducing my fellow panelists. I am joined today by Nicholas Vickery, who is the Global Head of Private Equity Funds at the IFC, by Amy Wang, who's the MD and Head of Credit Strategies at Blue Earth Capital, a global impact investor. And finally, by Richard Okello, who's the founder and CEO of Sango Capital, a Pan-African funds and direct investment firm. So welcome to my fellow panelists, and thank you for joining me this afternoon. So the format today is we're going to spend an hour together, and then we're going to have a discussion about our thoughts on the private credit as an asset class in Africa. What we think about its relative merits, whether you're a pure commercial investor, a DFI, or an impact investor, and what place does private credit have in a properly diversified portfolio in today's world? As I said, I'm going to open up for Q&A, so please do remember to put it in the chat box. But I'm going to start by first framing, at least as I see private credit, as a DFI at BII, and then I'm going to turn to each one of the panelists to hear their perspectives and for them to share their views. So just to start, we've all seen how private credit as a business, as an asset class, has grown both in Europe and in the United States post the financial crisis. And we all know the drivers of this. Punitive capital measures through Basel III, low interest rate environments, pushing banks away from really extending credit into the mid-market. And this happened quite quickly, both in Europe and the United States. And managers filled the vacuum that this created by attracting institutional capital to put to work to basically chase yield in a low interest rate environment. Now we saw this phenomena for several years, and it's grown to basically an asset class by 2021 of about $1.2 trillion. So it's a successful, scaled, established business that generates returns across the types of private credit to institutional investors at scale. So the question we've been asking ourselves at BII and at the other DFIs is really, what is it going to take for this phenomena to come to African continent, given the dynamics and the realities of the African continent currently faces? So in many ways, what we saw in Europe happened in Africa as well. We saw big banks exiting the continent altogether. We saw the local and regional banks also retreat to a large degree from extending credit to the mid-market, preferring to put their balance sheet and spare capital into the T-bill market. And this was really a phenomenon that we've seen build for the last few years. And the result is a huge financing gap across the continent. Whichever measure you care to take, credit creation as a percentage of GDP, sub-Saharan Africa is by far and away the lowest in any continent at 38%. So with very little supply of credit on the continent, and the demand for the credit by strong, profitable companies is largely being unmet. It's our thought that, but in the hands of experienced asset managers who can be very selective about the credits and choosing the best credits and using well-known structuring techniques where you can actually protect the downside and capture some of the upside. This strikes us as a very appealing asset class to invest into. We see it as essential to function in any financial market. providing growth capital to the mid-market. And especially in times of high interest rates, inflation growing, volatile exchange rates, it's our belief that this asset class and this product is best suited to put capital to work and earn a really attractive risk-adjusted return on a non-correlated basis for any portfolio manager, whether you're an emerging market, fixed income, impact, or pure global commercial investor. So that's our thesis. And I'd like to start now by sort of having framed it, is to ask my fellow panelists to share their perspectives about and their experiences investing in this asset class. And first I'm going to turn to Nicholas, because the IFC's got more experience than all of us at doing precisely this across emerging markets. So Nicholas, if you could just share your perspectives and learnings for the next 10 minutes, that would be much appreciated.
Thank you, Stephen. So when we look at so IFC is a very large investor across emerging market funds. We're invested in over 300 funds with 200 fund managers, and we've invested in pretty much every different type of asset class, whether it's growth equity, venture capital, but also infrastructure and debt funds. And when we look at the the specificities of Africa, what we see as a market is that it has on the strength what it has going for it for private equity investing is really it's growth based. So a lot of the products which are offered or that private equity funds invest in are linked to sort of first-time consumption for local consumers. It has very low leverage, and then it's supported by the growing demographics, especially the growth of the urban middle class. So there's a lot of demand for services, and so that benefits the private capital sector in general. When we see, when we talk to investors and we ask them, why are you not investing more in Africa? What we hear is that there's sort of two factors mainly that they're concerned about. One is the devaluation risk, which we've seen across the continent, and we're continuing to see it. And then the second is the slow exit pace, and for that private credit really has a strong role to play because it addresses these two areas in particular. Most of what we see in the private credit space is done in dollars or euros, so the currency risk is essentially passed on to the borrower, but in exchange for sort of not giving up upside. And the second is there's more certainty over what the exit pace is going to be. So a lot of players call this a sort of self-liquidating instruments, where you don't have to find a buyer in order to get your money back. And so in this market in particular, where we're seeing uncertainty and where we're seeing a lot of capital flows moving out of emerging markets, private credit has a strong role to play, and that's why we've invested in a few of these funds ourselves. We've invested in private credit really sort of through two ways. One is we've invested in funds where the investment thesis is around private credit. So in Africa, we've invested recently in a fund called Vantage. And that's how they structure their other products. We have a program to do distressed assets, where also the instrument that's used is private credit, and we've used it also through some of our small business funds program, which operate in low-income countries, where the instrument that's used is mezzanine type of financing. So that's that's one way we've used private credit to our own benefit as an investor. The second is we're seeing more and more growth equity funds or these small business funds that we invest use it as an instrument. So it's not necessarily the whole thesis of the fund, but it's part of the thesis when there are times of uncertainty, when there is a risk of devaluation or a risk that the exit is not fully in place, then fund managers use private credit, and so that's probably sort of a large part of our portfolio is structured as private credit or mezzanine, but in even along with other types of instruments, which fund managers can use more on an opportunistic basis. And we're starting to see it also in the venture capital space with the use of venture debt. So it's an instrument that we've also used for our own balance sheet. So IFC invests about a third of its equity investment through funds, but 2/3 of it is done directly. And if you look at that space, the what we call mezzanine investing, that's actually been one of the sort of the most accretive part of our equity and quasi-equity investment type. So as an instrument, it's something that we support and we do for our own account. Thanks, Stevens. Back to you.
Yeah, no, thank you, Nicholas. And that's very interesting perspective because you cover it across from, as you say, from distress to small business, venture funds, mezzanine. So there's quite a lot of a sort of variety in the private credit space that we also obviously see in developed markets. And each one of these, increasingly have a defined sort of range of returns that investors expect to get for that kind of risk, depending upon where you are on the capital structure. So I think in the course of the discussion we'll have today, we'll definitely get into that sort of relative value discussion at some point. So, but thank you for those comments, Nicholas. I'm going to ask Amy to share her perspectives from where you sit at the head of credit strategies and how you're seeing the African continent in today's market.
Sure. Maybe quickly, though, first, let me describe the platform that I sit in. I'm with Blue Earth Capital. We are an impact investor that was the incubated impact arm of Partners Group, a large private markets asset manager. And what we have done over the last year is spun out to really be able to fully dedicate our focus on providing diversified impact, both social and environmental, investments into the emerging markets as well as developed markets. We are a platform that is just shy of 900 million in total AUM, and we actually run 3 different strategies. We run a private credit strategy, which is largely direct, so being on the ground and investing in these businesses, as well as a fund strategy, in which case we can invest both in equity funds and credit funds. So these two obviously work very well together in the credit fund managers that we can collaborate with on continent alongside our direct business, largely hoping to harvest co-investments. Lastly, we also have a direct private equity strategy. But as an impact investor, maybe I'll just hone in knowing where we stand. Impact is at the very core of what we do. Stephen, you mentioned some of the statistics before, but the world is super wonky right now. Inflation is high, rates are all over the place. COVID, we're just coming out of that. That has led to dramatic increases in the level of folks living under extreme poverty. So there's over 650 million people living in extreme poverty. That is at the very core of what we do. All of our investments are trying to orient towards where the need is greatest. Piece 1. On the other side, aside from the impact, we're also an investor. And key to that investment thesis with the different investment strategies highlighted is that concept of relative value. We want to optimize and maximize for the social and the environmental, but also need to deliver a market rate return to our investors and be conscientious of that. And is that, with that in mind, private credit and private impact credit in particular is something that we deem as extremely attractive for the entire platform, largely because historically you can see that it's really uncorrelated to the broader market. So we can take equity bets here and there, not to push on the equity guys, it's great asset class, but private credit as an asset class, there's less than a 0.1 correlation to global equities, 0.15 correlation to global bonds. And this has delivered consistent returns over years of crises, including that through COVID. And we think that's largely due to the fact that impact credit has oriented around smaller businesses, smaller, medium businesses, which are incredibly resilient. These businesses, despite what's happening in macro terms, will continue to grow. They are our globe's engine. They account for over 2/3 of global employment. So with that in mind and with that focus, orienting and maximizing around impact, as well as the resilience of an asset class, we find private credit particularly attractive. And in Africa in particular, we see that thesis to play out absolutely. We have investments both directly via senior all the way to mezzanine direct lines, as well as via intermediated fund exposures. One of our fund investments is Ethos, say a peer of Vantage, slightly smaller, largely on the financial services and healthcare side in terms of overall exposure. Maybe overall, what we see for the continent, it really does map to what we're seeing across the board for credit as well, is we're really excited about a couple of key areas. Healthcare, for one, it remains a vital need as healthcare spending is growing rapidly, particularly, say, in distribution of vaccines, where we see that there was quite a bit of disparity in vaccine distribution to begin with on the continent. These are some key theses that we think are just market needs that we need to solve for as just opportunities, largely in the continent. And secondly, in agribusiness and specifically food security. Food prices, as everyone knows, has already been pushed up via pandemic-induced labor shortages, and now they've been exacerbated via the ongoing armed conflicts. With food security top of mind for folks such as the IFC, the World Economic Forum, we see a lot of opportunity in profit-oriented businesses that would be aligning towards maximizing business opportunities in that sector. So that's a little bit of what we're thinking. To date, Africa has been challenging, despite these investment themes. Maybe to just hone in on what Nicholas was saying, it wouldn't be fair to say that it's easy to invest in the continent for many of the reasons that Nicholas highlighted, currency, local regulations, etc. But the concept of private credit and its capability to work in partnership with borrowers in their capital structure, be flexible and really align with what their needs are, and earmarking towards what is essentially a structured exit. That's very top on the list of how we can manage and ensure that an investment strategy in Africa is successful. So that's a little bit about us. Back to you, Stephen.
Yeah, no, thank you very much, Amy. Look, I mean, that was it was really interesting to hear about, obviously how you guys look at it from a relative value point of view and what is the market rate, which we will touch on, and how this is an uncorrelated to the broader market, and use some interesting correlation numbers. It was also interesting to understand that you were looking at specific sectors, which most private credit funds are beginning to just, they're generalist funds in Pan-Africa, and you've added another lens, which is actually being quite specific about which sectors you think have the highest impact, and applying a private credit sort of toolkit to it is also very interesting to hear. We'll come back to this relative value discussion, but because I didn't want to preempt some of Richard's observations, who I think it would be great to hear from Richard now, given where you sit in the market, to introduce your firm and your perspectives. So over to you, Richard.
Thanks, Stephen. So I think our perspective on this asset class is really actually goes back to why we set up this business, Sango Capital. So we set this up as a business that we hoped would bridge institutional private capital into Africa in size, either coming through our funds or coming alongside us to execute in different asset classes. We did this about 10 or 12 years ago. And I think if you think about that thesis, most of those investors, be they pension funds, endowments, foundations, family offices, sovereign wealth funds, essentially have one goal in mind, which is they have clients of different types, could be retirees or pensioners, or they need to provide scholarships or whatnot, that demand that they try to maximize their return, commercial return, and or maximize their risk-adjusted return, and obviously do that with some level of responsibility, right? So then they can't just sort of go out and do whatever they want, right? There's some level of responsible investing associated with that. So I think that's our context on this market. Over the last decade, we have, actually before we started this business, we spent, probably 5 years looking at all the asset classes in Africa and thinking about how people are executing, how ready the ecosystems were for the different asset classes. And then we have sequentially stepped into different asset classes as different pieces of those asset classes have become ready. So we've invested, and we do invest a lot in private equity, funds, and directs. Directs mostly next to managers. We are investing in venture funds and directs similarly. I think on the private credit, for private credit, we have spent a huge amount of time looking at it. We have not invested into funds, primarily because there's been, I think, a dearth, I would say, of institutional quality funds. There are some funds, I think, that are institutional quality that have been around a while, but it's not a market that has 10 or 15 or 20 funds, whereas in private equity, you'd have obviously quite a larger number of funds. So that's been one constraint. So the way in which we've approached that, again, coming from our orientation as investors and also our history in our previous lives, ran fixed income and debt books that were globally, credit books that were globally exposed. Our orientation then has been to find credit exposure within our private equity portfolio. So we have done direct transactions where we've got mezzanine components to those transactions, or direct lending components, or senior debt, or venture debt, although that's a much smaller piece of what we do. So I think that that's been our historic exposure and sort of thought around the market. Now, ironically, though, I think Africa is actually very well set up for private credit. So if I think about the global private credit space, today that 1.3 or 1.5 trillion, Stephen, that you mentioned, is approximately 15% of the global private assets space. And if you think about what that percentage is in terms of global private assets in Africa, it's a tiny percentage, probably 2% or 1% of total institutional private assets, if you think about private credit funds. What's ironic about that is that culturally speaking, I think the average user of capital in Africa understands credit better than anything else. And so when you do a deal that's an equity deal, a private equity deal, people have to be brought along to understand how that is valuable to them. However, if you are doing a private credit deal, they understand that from the time they're 10, right? Like everyone borrows from everyone. They know how borrowing works, how you repay people, what interest rates look like. And my sense is that the sophistication of borrowers, company or otherwise, around borrowing has actually grown. What has lagged that process has been the formation of institutional private credit funds, and also the education gap that local pension funds have with respect to private credit. So if you think about local pension funds in Africa, on average, pension funds are, pick a country, as low as 4% of GDP to as high as, 70, 80% of GDP in terms of size of pension fund assets relative to GDP of those countries. So there's a lot of capital that today is basically either in local public equity markets and then gets stranded because it can't exit, or is in local government bond markets and understands how to lend to the government, understands what spreads look like, but doesn't have the credit option into which they can sort of step into, right? So I think one of the opportunities that actually exists to accelerate private credit, and this is not unusual, this has happened in the US, happened in Europe, same exact thing, is for private credit funds to source capital from local African pension funds. Because the understanding of that asset class exists, but there's a gap in terms of that understanding with respect to, I lend you money and you provide a return, and understanding of local pension fund trustees, of fund structures, of funds operating private credit strategies, of the sleeves within that exist, and so on. And that's a gap that I think can be closed and should be closed quite easily. So I think that's one of the big opportunities that exists today. That opportunity is particularly relevant, I think, for Africa because of the FX risk, which is, if you are a dollar-based investor, you obviously have a FX risk coming to Africa. And if private credit for you is an absolute return strategy, the bar to generate the type of dollar-based private credit return that makes you comfortable as a dollar investor is very high, right? And starts to get into the equity return space, which is not always attainable, versus, because of the FX risk that you take, right? Versus if you're a local pension fund, the bar for you to outperform local government bonds that might be at 10% in local or 12% in local, if you're using a private credit fund in local currency, is actually very attainable, right? So I think there is an opportunity there. I think the other, as we've started to spend a bit more time now on a few funds in that private credit space, I think we will deploy some capital there. I think part of the challenge for us is that the threshold for return, and we'll get into the return conversation, Stephen, as you highlighted, for our equity-oriented mandates is quite high, and a lot of credit funds just don't naturally fit into that. And so then the trade-off becomes multiple versus IRR. Do you want to take a lower IRR and lower multiple in exchange for IRR and recyclability of capital, or just wait for a higher multiple in terms of return on equity, right? So I'd say that's our orientation to that space.
Yeah, no, Richard, you covered a lot of ground and really interesting. I do think that whole dynamic between local currency and dollar credit is something we should explore. And certainly the local pension funds versus international asset managers. But let's talk about international asset managers as distinct from African pension funds for a second, and try and understand a bit. We all seem to violently agree that it's a really interesting product. It suits the markets we're in, and it suits the African continent for the reasons in different ways you all suggested. It's self-liquidating, the borrower understands what they're doing, they can organize their affairs around different types of debt more instinctively than they can from equity. So there seems to be quite a powerful match between what borrowers are looking for and what investors are looking for. And Richard, you touched on some of the constraints, which is lack of lack of actual funds as a potential constraint to invest in. But I think what I'd like to ask each one of you is your perspective on what is the difference of an absolute return. Is this one of the issues that is precluding international capital coming into what we see so obviously as a compelling asset class? If you compare a like-for-like European piece of credit with a low amount of leverage in it, earning 6-7% return, versus an African piece of credit with a similar or lower leverage, same tenor, like-for-like, you could probably, command another 500-600 basis points if you locate that borrower in Africa. Now, surely that's sufficient to sort of explain to a portfolio manager that you're getting a good risk-adjusted return in addition to the non-correlation and the diversification. So do we think it's a perception of risk problem and the yield isn't sufficient, or are we misreading this somehow? Amy, I know you've looked at this, so I'm going to start with you.
I would say absolutely. I do think there's a perception of risk versus actual one. But secondly, I would challenge, what is the benchmark? what is the benchmark? We're talking about private credit here, so let's orient toward private markets, putting aside the public markets, although I understand asset managers have to look it up. But taking data points from being lucky enough to being able to leverage Partners Group data of over 25 years investing in largely fund managers and private markets opportunities globally, what we find is that the expected hurdle for a fund investment, a private equity fund investment from actual returns ranges in net terms between 11 to 15%. In terms of direct private credit, we're going anywhere between, and this is the low, it can actually be quite lower if we're talking about senior US assets, but throw that out and make it a little bit riskier. Direct private credit, we're talking about anywhere between 8 to 11 in terms of absolute levels. So here, this is what the global markets, 25 years of track record has achieved in actual returns. So what are we underwriting to for Africa? What if we can structurally manage the concerns around the commercials, the concerns around the social in our case, and within the commercials, the impact of currency via the form of FX solutions, via hedges, etc., that can lock in absolute USD returns that then prescribed to the levels that we're speaking about, with a fund manager delivering again 11 to 15, I'll bet that everyone on this call underwrites above and targets above that return, in which we do. As a matter of fact, we underwrite to anywhere between 15 and 20. That said, the actual return demonstrated from that is the 11 to 15. So I challenge, we're already doing better than what historical track record, again, of 25 years has shown us. That's my caveat.
Yeah, no, that's very interesting. Nicholas, I know, it'd be interesting to hear your perspective. I mean, obviously as a DFI, where you may have a slightly different sort of dynamic, but you're also solving for mobilizing private capital. So do what does what Amy sort of set out resonate?
So this is interesting, Stephen, because it's a good question, because there's different types of credit within private credit. Amy was referring to it. There's you have the senior secured, you have the subordinated, and then you have the ones which are more mezzanine with upside, and they don't have necessarily the same level of risk. And what we found is, for instance, when you want to get some of the mezzanine credit, which is expected to have sort of similar returns as what you have on equity, but without diluting the other shareholders, so that makes it an attractive product. Some of the features, when things go wrong, you don't have all the downside protection you thought you did. So it's these instruments do carry a fair amount of risk if you go towards the sort of the higher yielding of the private credit. So it's more, for the fund managers, it's more, what are you able to structure, what are you able to get as returns, and what's the expectation from your investors. But some of them also do behave a little bit like equity when things go wrong, and so that's part of the risk. That's what we're learning along the way as well.
Yeah, I mean, it's interesting. One of the questions we've had in the chat is, do investors believe senior debt is actually senior debt in Africa? i.e., are there concerns about legal and regulatory environment? So not the higher returning, higher, risky mezzanine, but just even at the senior credit level, that the perception is it really senior, and can you enforce on your security, etc. So therefore, are the returns appropriate? I don't know how you feel about that question. I mean, Nicholas,
we don't have a lot of experience in that segment, because for us, when so this is something that's specific to IFC as an investor, but we because we're an international AAA rated institution, we have pretty high requirements with regards to our economic capital. And so when we invest in a fund, when we invest an LP stake in a fund, it's considered as equity. And so this is where we have to set aside 80% of economic capital. So we haven't been doing it when we have not been investing in senior debt funds, except when we're able to match the risk rating methodology of the fund manager with IFC's own risk rating methodologies, which follows the Moody's standard. But that's a pretty high bar. Not everybody has the same approach. So that's been a small part of what we've been doing, but that's linked to our own requirements on economic capital, which not every investor is going to have. So the portion of the senior debt is one which we know probably the least. We have more experience with the mezzanine and the quasi equity type of private credit.
No, okay, fair enough. I mean, maybe Richard, to ask you the same sort of question, which is, is the perception of risk from the international investing community, not the African pension funds, but is it appropriately sort of capturing that risk premium in a way that overstates or understates the risk? I mean, is it a perception issue or is it real in terms of, I don't know, this issue, for instance, of enforcing on security of a senior loan because of jurisdictional issues or legal issues? Do you have a view?
Yeah, I have a view on that. But I just wanted to quickly respond to what Nicholas just said, the comment he had on senior and your question on senior, sort of senior debt, senior credit. So I think you can get a sense for whether the type of risk you take on senior credit is globally comparable by looking at what banks do and looking at loss rates, because a lot of African banks are essentially doing a version of senior lending. Lots of blue chip, lots of crazy asset cover that they actually, frankly, really shouldn't have for that type of client. So I think you can get a sense for whether that's comparable. And I think if you looked closely enough there, given the realities around how banks lend in the region, and given how stringent African central banks are in bank supervision, I come from a history of, my dad used to run a bank supervision group in Uganda. The stringency of bank supervision in Africa is such that the type of lending that banks are doing at that level, especially leading banks, is going to be globally comparable, actually in some cases better, frankly. Now, I think that's just the reality. However, perception is reality, right? So let me bring you back to the question you asked around risk, right? So I think if you are a US endowment or a European pension fund or an Asian family office, your least risky position is home base, always. Just like it is here, right? So if you're sitting in South Africa, if you talk to South African lenders, you talk to Rand Merchant Bank or Standard Bank in South Africa, the way they think about lending, a couple countries north of the border is just more risky. That's just how it is for most people in their minds. Whether that's the reality or not is almost, I don't want to say irrelevant, but that's the starting point that people have. So the challenge with that though is then that when you think about things like leverage, like Stephen, you made the point that, hey, if you can get a certain type of yield that's essentially unlevered in Africa, isn't that less risky than the US? Well, mathematically it is, you would think from a risk perspective. However, if you are a US institutional investor, your lens on that is going to be, well, how often has leverage been a problem for me? How often has leverage caused me to lose money? If the answer is rarely, then I am much more interested and much more incentivized to take that leverage and maximize my return, because that's how I get the bonus, let's say as an investor, right? For institutional pension fund or whatnot. So I think if you understand that, then it has an implication for how we think about what's a compelling return out of Africa, which is not just the mathematical difference of those two return streams, but the executional reality that you have, right? So for someone to leave home base and come to some place, let's say here, they're going to think about all the risks that we just mentioned. And there is a space of debate where you can say to them, hey, here's how you have a misperception of risk relative to reality, which is real. But that is not going to be completely aligned with how we think about it sitting in the market where we have the most comfort. And I think that's very important because oftentimes our conversation starts from the market where we have most comfort. So as people investing here, we say like, it's totally unlevered. Like, why is everyone worried about this? And the US investor is saying, hey, my leverage is incredibly cheap. My investors, my fund managers know how to manage leverage. They've done this for decades. They've never been caught out on leverage. Why should I be worried? I get paid more if they use leverage. I'm going to take that, right? And so we have to try to bridge that in our assessment of relative risk, I think, between sort of the different markets.
Yeah, no, fair enough. I think maybe that's a very good observation. And you know, it made me think about how should we start trying to build that into how we position the African private credit space. But one other dimension we haven't touched on as much as we need to is the whole world of impact and ESG and the positives and negatives about this in the African context. So if we've discussed the sort of the commercial dynamics and the relative value dynamics, but if we add this sort of the impact variance and sort of say, well, in addition to the returns, and on a relative basis we can debate, but there is some very clear sort of impact benefits and ESG benefits, depending on which perspective you come from, that an investor can certainly seek to gain from investing in the African private credit space, whether it's mezz or senior. And some of the questions we're getting is sort of saying, well, with you know, if you're targeting this sort of mid-market, smaller businesses, how do they handle the ESG requirements that are being put onto them? And yet the investor base want to have that positive impact for reasons we all subscribe to. So I'd be interested to hear, Amy and then Nicholas, your perspectives on this issue of, you know, how much value do you guys put onto the impact side of this? This is growth capital into the mid-markets, sort of the SME businesses that appropriately can borrow dollars, generate employment and foreign exchange. And how much of an onus or a burden are we putting on these companies to sort of report and deliver? Just sort of how you feel about that, Amy, and then Nicholas, because we're getting several questions along those lines.
If you don't mind, I'll go first, Nicholas, because I have some comments about the DFIs as well. And I would say it's tough. I mean, it's a catch-22 almost. You, as an impact investor, as I mentioned, that is core to why we're looking to open up this market. So key to ensuring that we are committed to that strategy is to align an impact thesis that aligns with the goals of the business, mapping out a value plan, KPIs that can track what defined impact that we have. Now, also, we are working with high growing businesses that, I mean, even in the US, if you're talking about a business that has, say, 50 employees, what systems do they have in place to be able to truly deliver on the KPIs? And I think that's where it speaks to just Richard's point, why there just aren't that many funds out there. It has been hard, but there have been increasing regulations, led for decades by the DFIs, but now being taken on mantles by governments. For instance, the entire European Union, the SFDR regulation around what does it mean to be a green and an ESG fund, requiring fund managers to ascribe to certain thresholds of reporting and goals. And there's now more guidance to at least align to what is the best practice that is required by the fund manager to dictate then down to the underlying businesses. Now, of course, can we, the list is long, and how do we actually effectuate that list out? does mean that oftentimes the smallest and the most philanthropic opportunities are just unfortunately not financeable from a manager that allows itself to ascribe to that, both the DFI ask as well as the European regulations. But what we have done, and as from our perspective, is try to streamline the requirements from what the DFIs have requested, as well as the regulators, to what are the key components that really we can feel comfortable with, and then figure out a way in each case by case, credit by credit situation, how does this actually map with the business model of the company? How does this align with the business outputs, the commercial outputs? Because otherwise, if you're just giving them a laundry list of this, that, and what everyone else wants, it is completely unburdensome. So the work lies with the fund manager to see what are the key points that are valuable to report on, for us to see where we can create value, and then how does that ensure that knits with the overall business model, so that it is a intrinsic part of what their financial and commercial success would be. So that in essence, we think it just is aligned perfectly with being an impact investor. That DNA connectivity with the ESG targets versus the financial targets have to be mapped. Not given that, I can't answer for if I just optimize on one, how do we ensure that we fold in the other? And I think that challenge is a little bit more difficult, but that's, I think, why we are an impact investor. And I choose to be in this space because I think that the world is moving towards an environment where all folks will need to incorporate ESG and impact within their overall goals. And this is us just getting a head start to really work with the key leading businesses to fold that into their businesses.
Yeah, and Amy, look, you bring up some really interesting issues. Nicholas, do you want to sort of give your perspective on this, and then I'll also chime in from the DRI perspective?
Sure. I mean, from our perspective, this private credit has allowed us to reach more companies, and especially in the Amy was saying in the smaller segment, because when you're investing in these small businesses, and these are companies which have revenues of less than $5 to $10 million, there isn't necessarily going to be an exit for you if you provide equity. So, but by providing a private credit solution, you're able to give them financing and structure it with some upside, so you get the equivalent of an equity investment in the company that allows them to invest in capex or to expand and grow their business without necessarily in a way that they wouldn't be able to get from financing. They wouldn't be able to get from banks for multiple reasons. You were talking about at the beginning from capital requirements, whatever's the banking sector has been affected. So this private credit solution has allowed us to go into more frontier, low-income countries and target smaller businesses. So from an impact perspective, we're seeing a lot of good results. On the ESG, I think we break it down into I'd like to break it down into two pieces. There's the ENS and then there's the governance. On the ENS side, we have a methodology that we developed for our financial institutions for the work that we do with financial intermediaries. So we were able to replicate a lot of that to our funds who are doing private credit. On the governance side, that's possibly the area where there's less of an impact, because when you're investing equity into companies, so compared to a growth equity fund, that's going to take board seats and really work on the governance aspect. If you're doing that through the private credit angle, you may have the ability to do so, but not every time. You're not necessarily going to be given a seat at the table in terms of the governance. So that may be probably the difference.
I was just going to jump in. We don't define ourselves as impact investors. We define ourselves as more of a responsible investor. But I think that one of the arguments that we've had for the longest time is this notion that investing in businesses that are sustainably thriving is the biggest impact you can have in a geography like this. And that if you then take any of these asset classes, if you take private credit and you say the starting point of the business owner is they have leveraged themselves to the hilt, they've probably taken out a mortgage on their house, this, that, borrowed friends and family, maybe a little bit of ridiculously expensive bank lending. And now what they need is something that's a bit more institutional that can get them to the next stage and get them on their way. For those businesses that understand that, my sense is that the ESG execution is not the roadblock. There are other roadblocks for sure. They might not want to give you certain rights or whatnot, but if they understand and are passionate about building a great business, then there's a workable ESG execution runway that will work for them, because funding is a much bigger problem for them, right? They just can't get anything done without the funding. So I think if we have that orientation as we think about private credit, we'll be shocked at how many businesses are willing to deliver on the ESG imperative with the right partner, the right private credit partner. Because on the equity side, I can tell you that you could go way down in size of business, and we've seen this in the private equity funds we invest in, for example, and they're still getting a lot of progress. It obviously doesn't happen in one shot, but they're getting a lot of progress on governance or social metrics or things like that happen with small businesses, where you would think that would be a challenging execution requirement. By finding small businesses where the orientation of those people is, I want to 5x my business or 10x my business over the next decade, and I think you can help me do that. And now part of that is you're going to show me how this ESG thing is part of that 5 to 10xing my business, right? That's sort of the orientation. So I just want to make the point that I think that size by itself, in my mind, is not a constraint. I find that the bigger constraint is mindset around whether or not you think this ESG thing actually adds any value to your business if you're the owner of the business, right? That seems to be the biggest roadblock, whether it's a small, mid-sized, or even large business, frankly. We've seen some large businesses now portfolio on the equity side where it's a struggle to get that sort of impact done, not because they don't have the resources or they can't hire ESG people, but because they just don't believe that adds value to the business. And when that switch goes off is when the change in execution starts to happen.
Look, Richard, I would agree with you, but just to also answer Amy's question from the DFI side, I do think we need to be, more aware and balanced that this is a process which takes time and it's demanding, and we need to be sensitive, to how much capacity these firms have. Even once the light switch has gone on, and making sure that we're coordinated and proportionate in our sort of plan to get to the right outcomes. So I do think all DFIs have more work to do on that. But look, we're sort of coming to the end here. So I wanted to sort of pose one last sort of quick fire question to you guys, because I think it's been a very interesting discussion around, the merits of private credit broadly defined, especially on the African continent, but I wanted to hear your reactions just before we close on we're in a very volatile market globally for lots of reasons, and whether it's interest rates or currencies or food security issues, access to capital, people are risk off. But there's still a lot of liquidity sitting in asset managers' hands, and they may be down quite a bit on their valuations on their NAVs. But in that environment, what do you think is your sort of forward-looking view for African private credit as an asset class, and what would you like to see happen to make it get to the scale that it should get to, and have the purpose of providing that growth capital to really be a game changer on the continent? What's your sort of forward-looking view, and what would you like to see to happen for it to become a reality? Amy, why don't we start with you?
Sounds good. Maybe despite being a credit investor, which is prone to being risk off, seeing the downside, etc., with everything that's happening, what I would say is the sentiment within our team is actually one of excitement. It's one of it's an anticipation for the ability to be quite selective, as there are back to the core, we think that these businesses, these small and medium businesses, are resilient, they continue to grow, and we know they're good ones. With market forces the way they are, there are just greater dislocations that have impacted their business, shorter equity runways, a little bit slower in terms of the bank financing, which is already limited to begin with, which then allows us as private credit investors the opportunity to come in and really show where our value is, how we can partner with them through this time, get good relative value, and develop a long-term partnership. So broadly, we're quite excited about being smart and careful, but excited about the coming few months because we do have the luxury of dry capital. That said, what would make it easier, what would make it more scalable, would be an answer and a resolution to the currency portion. And this is, I'm sure people have heard this time and time again, but this is something I would plead, and I've asked many of your colleagues in other DFIs and in your own DFIs, if there is a solution somewhere within there to help manage currency risk, that is something that would really catalyze and unlock quite a bit of capital. We talked about relative value market rate returns before. There's ranges of capital being thrown senior mezz, but we're talking single digit, double digit, whatever it is. But what Richard said of adding that FX component, if you're talking about taking on that currency risk, that is anywhere between, on the best side, 700 basis points to, on the worst case, 25% or something of currency risk. And by unlocking, or by being able to absorb that risk via an alternative, differently motivated provider, that would allow us to really unlock a lot of capital.
Right. No, I mean, yeah, no, thank you for that. Richard, your final thoughts?
I think that if you look historically at private credit returns, I mean, what we've seen, what I've seen is you tend to get outperformance right around the time that the world is coming out of a liquidity squeeze and liquidity just starts to ease up, right? So because you've got a ratchet in demand for credit, right, with a shrinkage in supply of credit. So as Amy is saying, lots of selectivity. I think that's starting to happen now. And then when that illiquidity starts to kind of flatten out and ease off a bit, I think is when historically you've seen the best performance. I think if we want to attract large-scale institutional capital, I think you need a couple of things. One, historically, the types of private credit investors that are purely commercial, that go to emerging markets, are going to be people that access top quartile or top 5% or top percentile returns. Okay, so what are top quartile returns? 20% in dollars historically. It goes much higher for top percentile returns. So I think what's going to get people excited is a runway that doesn't necessarily have to give them 20%, but gives them a premium that's probably 500 basis points over what they have. That's believable, right? So you're going to need to see private credit managers that say, hey, your stacking of returns in the US or in Europe looks like this. I can give you this because of this gap that exists in my market that you don't have, and that gap is believable. I think if you have that, you will see capital flow into private credit funds. I think the other thing that I would caution on is, I think that on the one hand, it'd be great to see DFIs catalyze some private credit funds. But if you look at other sort of frontier markets, I think you've had periods of time where private credit funds were catalyzed where the principals were not historically risk takers. They were transactors. They were investment banking transactor type people who really didn't know how to take risks, and those sort of fell out of bed, right? So I think it's really critical in this market that the first 10 funds are great teams that have been risk takers before, because that's what you need to build momentum in terms of private credit flowing into those types of funds without needing to have DFIs provide cushions and things like that.
Right. Thank you. Nicholas, you have the final say.
Thank you, Stephen. Look, I think I think the market is very favorable for private credit, because if you look at African companies, they have fairly low leverage, so there isn't the risk that you're going to sort of add on debt to debt. So from that perspective, it's a good market to go after. And then in a time of uncertainty around the other aspects, that we've talked about, this is a sort of a safer product, if you will, to invest in from an investor's perspective. So I think there's good times ahead for private credit in Africa. What I'd like to see is that it's not just about providing the financing, but it's also about helping these companies create value, and especially the smaller or mid-cap companies in these low-income or fragile markets that need the institution building, the best practice, and what we discussed in terms of how can these fund managers, which are offering private credit, can also provide the hand-holding and help these companies grow their business, so that we see sort of more impact, and especially applying norms in terms of ESG that are going to help these businesses grow in a even more sustainable way.
Well, good. Thank you, Nicholas, for that. I think we have to draw the virtual panel session to an end. Hopefully, this has generated some real interest and increased the awareness about this asset class to those listening. I think I forget who said it, but it was one of you guys said this is an asset whose time has come in Africa. So hopefully, this has sparked your curiosity enough that you guys will go away and maybe do enough of your own homework around it and reach the same conclusion. So as I say, hopefully we've increased awareness and stimulated some thought on as a result of this panel discussion. I'd like to thank Amy, Nicholas, and Richard for having this really interesting conversation, and Joe Mate from BII, who leads our push on private credit on the continent, for putting this together. So thank you to the three of you for your time, and for everybody who has attended for the last hour.